Welcome to this explainer. I'm absolutely thrilled to have you here. Today, I'm going to be acting as your consultant on the ground, briefing your international audit team on a really critical compliance trap that catches out countless global businesses. We are unpacking the complex localization of financial software for Turkish-speaking regions across the Mediterranean. It's a fascinating topic, honestly, because it blends language, law, and high-stakes accounting. Let's get right into it.
So, does a shared language automatically mean shared accounting principles? Well, it's a totally dangerous assumption to make. You might think, hey, if we translate our enterprise software into Turkish, we're ready to deploy it in literally any Turkish-speaking region, whether that's Turkey itself, the Turkish minority areas in northern Greece, or the Turkish Republic of Northern Cyprus. But as we're about to see, shared language absolutely does not equal shared fiscal law.
Okay, let's quickly run through our agenda for today's executive dossier. We'll be looking at language versus legal compliance, the LP and TDHP frameworks, navigating taxes and currency, tracking TRNC VAT rates, Class 7 manufacturing expenses, and finally, mapping IFRS to Turkish.
All right, diving right into Section 1, language versus legal compliance.
So, here's the absolutely crucial point. Whether your software interface is translated into Turkish or not, the ISO country code is the ultimate supreme authority on your reporting structure. It's kind of like the boss behind the scenes. The language code, TR for Turkish, is literally just the user interface, but it's the GR for Greece or CY for Cyprus that actually triggers the legal requirements. So a company in northern Greece might use a TR-GR setup, Turkish language, sure, but strictly Greek legal compliance. Meanwhile, Northern Cyprus uses TRCY, again, Turkish language, but a totally separate fiscal system. You really can't just use a one-size-fits-all Turkish localization here.
Moving on to Section 2, ELP versus TDHP frameworks. The comparison here really brilliantly illustrates the core divide. On one side, Greece, being an EU member, adheres strictly to Hellenic Accounting Standards, known as ELP, and EU directives. It usually operates on a pretty flexible structure based on the International Financial Reporting Standard for SMEs. But then, look over at Northern Cyprus. They legally mandate the Turkish Uniform Chart of Accounts, or TDHP. And listen, this isn't just a friendly suggestion. It is a strict legal mandate that organizes accounts into incredibly rigid classes 1 through 9. If you accidentally deploy a TDHP structure in Greece or an ELP structure in Northern Cyprus, you are fundamentally breaking local financial reporting laws. No way around it.
Next up, Section 3, navigating taxes and currency. Now let's talk about the daily operational realities, because there is a stark contrast here. In Greece, obviously, you're operating in euros, and every single supplier and debtor record has to track the Greek tax ID, known as the AFM. But jump over to Northern Cyprus, and transactions are primarily recorded in the Turkish lira. Plus, your system has to capture the VUK equivalent, that's the local tax procedure law ID. If your Turkish localized software just blindly defaults to the Turkish lira and VUK settings across the board, your Greek operations will instantly fail their compliance audits. It's a real operational disaster waiting to happen. Getting a bit more granular, Section 4, tracking TRNC VAT rates. If you're used to seeing 20 or 24% VAT rates in other parts of Europe, you're going to need to update your parameters for this region. Unlike Greece, or actually even Turkey itself, the standard VAT rate you're going to encounter in the TRNC is 16% for most goods and services. And that sits right alongside a 5% reduced rate for basic essentials like foodstuffs and medical services. And to track these local rates, you absolutely have to utilize a strict TDHP sub-account structure. You can't just throw all your VAT into one giant bucket. Accounts 191, which is your deductible input VAT on purchases, and 391, your calculated output VAT on sales, they have to branch off specifically to monitor these exact percentages. So, for example, you'll see account 191.16 tracking your 16% purchases and 391.05 tracking your 5% sales. Doing this is absolutely mandatory if you want to correctly generate the local monthly VAT return. So, how does all this resolve at the end of the month? Well, it's kind of like a precise reconciliation dance. At period end, the totals of your output subaccounts in 391 are used to offset the input subaccounts in 191. If your collected output VAT is higher than your input VAT, you settle that final net liability right into account 360. That's the ödenecek garive, or VAT payable account, and that's what you remit to the government. This perfectly structured flow is what ensures an exact, fully auditable trail from your general ledger straight to the tax authorities. Moving into the weeds a bit, Section 5, Class 7 Manufacturing Expenses. Okay, so if you're auditing a manufacturing firm in the TRNC, you're going to see costs meticulously separated by type into Class 7 accounts. You'll have 710 specifically dedicated to direct raw materials, 720 isolating your direct labor costs, and 730 capturing general manufacturing overhead. This is strict analytical accounting mandated by law. It lets businesses track the exact nature of every single expenditure as it happens, right there during the production cycle. But here's the thing. Those Class 7 accounts, they don't just sit on the final balance sheet forever. The system actually works by recording these expenses throughout the year based on their specific type in Class 7, and then at period end, it transfers them straight over to Class 6 income statement accounts. This two-step process beautifully separates the daily, real-time tracking of what you spent money on from the period end calculation of your final profit or loss. And finally, Section 6, Mapping IFRS to Turkish. So, to succeed globally without accidentally breaking local laws, your international audit and software teams really should adopt this solid three-part strategy. Step 1, you start with an IFRS structure as your baseline template simply because it's globally recognized. Step 2, you apply the strict local compliance dictated by that all-important ISO code we talked about earlier. So that's Greek ELP accounts for your Greek operations and the rigid TDHP structure for your TRNC operations. And then Step 3, only after the structure is set do you translate the user interface into standard Turkish terminology so your local staff can actually use it effectively. I really want to leave your team with this golden rule today. Structure is dictated by law. Language is literally just the interface. Sure, a shared language might help your user navigate the menus and click all the right buttons, but make no mistake, the regional laws strictly dictates the numbers, the taxes, and the reporting classes behind the scenes. So, as you review your own Mediterranean operations and software deployments, you really have to ask yourself this vital question. Are you actually legally compliant in your respective jurisdictions, or are you just falling under the language illusion? I highly recommend you go audit your ISO country code settings today. Thank you so much for joining me for this explainer, and I really hope this empowers your team to navigate these incredibly complex localized environments with absolute confidence.